Hi, I'm here to talk about timing the market. Are you an investor who manages your own investments? Are you a money manager who invests for clients? Do you manage any 401k accounts with equity index ETFs? If so, have you ever wondered, is it possible to time and beat the average annual return of the S&P 500 index? Is it possible to accumulate wealth faster by pivoting between S&P 500 and cash at the right times? If you've had these thoughts, you're not alone. I share these same thoughts. It is very common to dream of accumulating wealth a lot faster than the index and retiring early in life. I'm Joe Fernari, founder of Ludicrous Returns. When I was getting my MBA in finance, I recall the finance professors preaching to never attempt timing the market. I've been investing since the 1990s. Early on, I followed what was preached, the asset allocation investment model. This is simply allocating a percentage of your 401k or IRA portfolio in a matrix of small, mid-size, and large cap index funds crossed by value, blend, and growth, and then periodically rebalancing those assets to ensure buying at the low and selling at the high. This is probably the best investment strategy for a buy and hold application. Buying and holding is just a form of maintaining equity position until you're older and start pivoting your portfolio towards bonds and other more liquid assets. Timing the market, on the other hand, is an investment strategy where positions change between equity and cash, pending market timing positions. Perhaps you've heard, no one has ever been able to time and beat the market over the long term. For several years, this really bothered me. I thought there just has to be a special formula that could objectively earn higher returns versus buy and hold. It is true that such a system would have to be tested and proven to work over the long term. It's the key word, long term, to be considered successful. A few mistakes early on in your investing career can cost you dearly for accumulating the proper level of wealth in the long term. Wealth accumulation is the key to achieving retirement and freedom. I started on a mission. I started conducting technical analysis in the S&P 500 equity index over a 52-year period. Technical analysis is analyzing past market price patterns to make an inference on how it will perform in the future. It's not generally taught as a textbook principle. I initially structured the analysis to look at patterns prior to significant market crashes. My goal was to find a common pattern that worked across several downturns. For several years, I banged my head against the wall. I was not able to find anything. Then, in more recent years, I decided to try some new approaches. As an engineer by trade with a passion for data analysis, I applied probability statistics in an analytical tool called design of experiments. This helps me find patterns with high correlation to predict good or bad times ahead. Suddenly, I found some amazing discoveries. What did I find? Patterns that predict. More importantly, I found patterns that predict consistently over 52 years of market index patterns. These are patterns that are objective and recognizable. I arrange these patterns into what I call the ludicrous market timing model. This is a model that will provide output of exactly when to be in 100% cash or 100% equity index, when to buy into the equity index and when to sell. I tested the model over 52 years from 1970 to 2021, which includes The 52 years includes the bookend years. I then refined the model and retested it several times until I hit a model that accumulated wealth a lot faster than buy and hold. What were the results? Before I proceed, I want to advise of one important disclaimer note. Past performance of the model is not a guarantee of future results.
Looking at a market timing model simulation period from 1970 to 2021, assuming a 10,000 investment on January 1st, 1970. So if we compare the market timing model in blue to the S&P 500 buy and hold in red, starting with the S&P 500, that $10,000 investment at the beginning of 1970 would grow to 2.34 million by the end of 2021. The market timing model would grow that 10,000 investment into 11.2 million by the end of 2021. That is 4.8 times the buy and hold strategy. Now let's take a look at a shorter time period. Sound complex? You're probably wondering, what does it take to use the Ludicrous market timing model? It's actually pretty simple. 5 to 10 minutes a week is the time requirement to assess the market investment status and compare it to model logic. Once you understand the logic, it's actually a very easy process. Market turbulence occurs, you may have to spend 5 minutes of daily charting the index. How does the timing model work? It takes equity index patterns and breaks into a repetitive process found to repeat over time. Basically, there are 7 stages of investment cycle status. The process starts assuming you already have established an equity index position. Starting point is moving it into cash at the appropriate time. The model logic will then advise when to get back into equity index. Examples of when this successful transition occurred include October through November 1979, March of 1980, the October 1987 crash, the 2000 to 2001 recession, the 2000 to 2009 Great Recession, and big market correction. I think most of us with investing experience in that time era will remember that period. The August 2011 crash, the January 2016 crash, October through January 2019, and then February through March 2020. Let's look at how the model performs in more detail, starting in the early years. This is a table that compares the wealth accumulation between the market timing model on the left and the buy and hold on the right. Starting in 1970, the model earned 20.7% annual return, including dividends, while buy and hold only earned 4%. The model did this only by buying and holding the S&P 500 at the appropriate times. And if you were to go through all the years of this table, which these tables are available on ludicrousreturns.com website, you can see in 71, the returns compare at 17.4% versus 14.3. In 72, this was a holding year. So this was a year that the model held the S&P 500 for the entire year. You can see that the returns match to reflect that. Other years where the market forms, it's actually quite effective at keeping you 100% equity invested throughout the year in good market times. Other examples of that include 1985, 1988, and 1999, as you can see in this table here. If we take a look at 1973, so this is a key point I want to show to kind of give you an idea of how the model works. So in this case, the market timing model only lost 5.3%, whereas the S&P 500 lost 14.5%. If we were to examine 1974, something very similar happens. The timing model loses 5.8%. The S&P buy and hold loses 26.5%. Now these S&P 500 buy and holds, which include the dividends, that data is obtained from slickcharts.com, updated August 6, 2023. My point here is the buy and holds, especially in troubling years, loses a lot of capital, whereas the market timing model, one of the strengths is to preserve capital in those bad years and kind of really leverage those volatile times, which really helps to accumulate wealth faster. But you got to follow that common set of logic and those objective rules to be successful with this. You want to learn how to apply the market timing model for your own investments. If so, here's your opportunity. I have a market timing model training video available for download on ludicrousreturns.com. This includes sharing the market timing model's secret formula and all the logic. It includes walking you through understanding the market timing process, including the 7 stages of market timing status. You will get live step-by-step instructions on how to use the market timing model with illustrative examples. Training videos will show when to sell equities, when to move into cash, when to buy back into equities, and including the buyback evaluation process. You'll get to see the process flow of how this entire model works, including all the sells, the buys prevented, and the buybacks to help you build your own skill to successfully apply the market timing model to your own investments. Or check out my book, Ludicrous Returns versus the Market. This also includes some examples of the market timing system, although not as in-depth as the training video. The book does, however, talk about a model I developed for individual stocks and how to earn phenomenal returns investing in individual stocks. If you are looking to practice your skill, you can also download the output spreadsheets, which includes the entire 52-year test period from 1970 to 2021, available for download on ludicrousreturns.com. This includes all the buy and sell timing transactions, including the prices that added up to the model wealth accumulation charts that you saw. You can use this data to practice your own timing application of market buys and sells and build your skill. I hope this video found you well, and I wish you the best of luck in investing and accumulating your wealth and dreams. Thank you.